All right, let's get right into it. You asked about Rezolve, and we have to start with the facts on the screen. Today is Saturday, November 8th, 2025, which means the U.S. markets are closed for the weekend. So there is no live trading for Rezolve AI, which trades on the NASDAQ under the ticker RZLV. We have to look at yesterday's close, Friday, November 7th, 2025. RZLV finished the session at $3.87 per share, which was a gain of about 1.04% on the day. Now, the expectation when you hear about a newly public AI company is often a smooth upward ride, maybe something that looks like the early days of NVIDIA stock. The immediate reality of RZLV is completely different. This isn't a simple growth story. This is a battleground stock. The first thing you need to understand is that this company is a recent de-SPAC, meaning it went public by merging with a blank check company, Armada Acquisition Corp. I, back in August of 2024, and it has brought all the volatility and drama associated with that process right into the public market. The stock has a 52-week range that stretches from a low of $1.07 to a high of $8.45. That is not the chart of a stable business. That is the chart of a company in the middle of a massive speculative debate, and it's one that is deeply entangled in some very serious legal and financial complexities. The common belief, the narrative that the company is pushing, is that Rezolve AI is a pure play AI company. They talk about their proprietary large language model called Brainpowa, which is designed to help retailers and commerce platforms engage with customers. On paper, this sounds fantastic. It's in the right sector, hitting the right buzzwords. Management has even issued guidance suggesting they could hit $150 million in annual recurring revenue for 2025. If you're just scrolling through headlines on investing sites or your Robinhood app, you might see this. Look at the $3.87 price and think it's a ground floor opportunity. But the reality is that the $3.87 price reflects a company walking a tightrope. This is not a stock you buy and just forget about in your Fidelity IRAs. When you look at the financials, the picture gets incredibly murky. The company is burning through cash at an astonishing rate. We're talking about net profit margins in the negative hundreds of thousands %. That's not a typo. This is a company that is spending heavily to exist. And that brings us to the recent news. Just last month, in October 2025, Rezolve announced it had secured $200 million in a private placement. The expectation? Great, they have cash. The reality? You have to ask why they needed it and who they got it from. The press release mentioned the funds would be used to eliminate warrant overhangs from a previous financing. That's not just a simple growth check. That is a complex financial maneuver to clean up a messy capital structure, a common ailment of de-SPACs that are struggling. This $200 million raise came after a $30 million unsecured loan they took out back in January. This is a company that is constantly and creatively seeking capital. And then there's the legal drama, which is where this story gets truly wild. This is the part that your standard Schwab Intelligent Portfolios or SoFi robo-advisor would never touch. Rezolve is currently involved in major lawsuits, particularly with entities named Yorkville and JBAAM. This isn't a small spat. This is over $1 billion Bitcoin financing agreement that was announced, but according to court documents, never actually closed. The company is now in litigation, with hundreds of millions of potential damages being discussed. This is a massive existential red flag hanging over the entire operation. It suggests a level of financial engineering, or at least financial desperation, that is far beyond what you'd see in a stable company like Apple stock. It's this kind of risk that separates self-investing traders from long-term holders. Someone doing SoFi active investing might try to trade the swings, but it's a high-stakes game. This brings up a serious point about due diligence, especially in the AI sector, which is filled with hype. Comment below. What is the single biggest red flag you've ever seen in a company's SEC filings or press releases? A billion-dollar Bitcoin deal that evaporates into a lawsuit has to be near the top of the list. So let's analyze the recent movement through this lens. That 52-week range of $1.07 to $8.45 makes perfect sense now. The $1.07 is the market pricing in the cash burn and the legal risk, the possibility of total failure. The $8.45 is the market buying into the pure play AI narrative, the $150 million revenue guidance, and the hope that the new $200 million placement gives them a clean slate. The stock is currently trading at $3.87, which is almost perfectly in the middle, telling us that the market has absolutely no consensus on what this company is worth. It is in a state of perfect tension between a story of massive growth and a story of potential collapse. This is the kind of stock that many online investing platforms like SoFi or Robinhood make accessible, but accessibility is not the same as advisability. Your individual brokerage account at Fidelity or Interactive Brokers gives you the power to buy it, but the decision requires a level of risk tolerance that is off the charts. So let's briefly cover what the company does, separate from the financial drama. Rezolve's platform is designed to be integrated into a merchant's existing mobile app. The idea is to make mobile commerce frictionless. You see a product, you scan a code, you get information, and you can buy it instantly. They are trying to create an ecosystem for mobile engagement. The business model is likely SaaS-based, charging retailers for access to the platform. The challenge, of course, is that this is an incredibly crowded space. They are not just competing with other startups, they are competing with the built-in functionalities of Apple stock's Apple Pay, Google Pay, and the massive commerce platforms of Amazon, Shopify, and others. They have to prove their AI engine is so good that it justifies a retailer adding another piece of software to their stack. Looking forward, the future outlook is a binary scenario. The expectation from management is growth. They will use the new capital, expand their sales team, and aggressively pursue the $150 million revenue target. They will frame the lawsuits as a distraction from a past, troubled financing attempt, and will try to focus the market's attention on their technology. They will likely be on a roadshow, trying to get institutional support from places that manage Fidelity investments or larger funds, trying to prove they are a serious company. The reality, however, is that the risks are severe. The new $200 million placement, while large, will likely result in dilution. The terms of that deal are critical. Are there more warrants? What's the conversion price? This could put a ceiling on the stock price for a long time. Furthermore, the legal battles are a huge drain on both capital and management's attention. A negative ruling could be catastrophic. So, the bull case is that you're buying the next big AI platform for under $4 a share. The bear case is that you're buying a de-SPAC that is financially over-leveraged, stuck in legal quicksand, and will likely need to dilute shareholders again and again just to keep the lights on. This is the kind of stock that many online investing platforms like SoFi or Robinhood make accessible, but accessibility is not the same as advisability. Your individual broker's account at Fidelity or Interactive Brokers gives you the power to buy it, but the decision requires a level of risk tolerance that is off the charts. So to summarize, the story of Rezolve is the perfect example of expectation versus reality. The expectation is a disruptive AI company, a new ticker, RZLV for a new age. The reality is a deeply troubled, highly speculative de-SPAC that has just come public. It's a company fighting for its own survival, trying to clean up its balance sheet and fend off major lawsuits, all while trying to grow in a hyper-competitive market. The $3.87 closing price isn't a value, it's a reflection of pure, unadulterated risk.